Welcome to Something More. We've got a great show. This time we're talking about a mailbag, all kinds of questions from our listeners and clients and shared experiences. So whether it's about recharacterizing Roth IRAs, 1031 exchanges, or all kinds of other topics, we hope you get a lot out of this episode. Join us, share, like, and follow. Stay tuned for Something More with Chris Boyd now.
Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
All right, welcome. Thanks for being with us for another episode of Something More with Chris Boyd. I'm Chris Boyd, certified financial planning practitioner. I'm here with Russ Ball. We are both of the AMR team at Wealth Enhancement, and so glad to have you joining us for another episode of the program. I mentioned last time that I've been doing this for 19 years now. Hard to believe it's been so long. In any case, we hope each episode brings you something useful, and we do hope you share your experience so that others find it as well. Today, we're talking about the mailbag. We periodically get questions from people, and whether it's from listeners like yourself, and incidentally, if you want to ask us a question at some point, you can do that. Probably the best way is to send us an email at amr-info@wealthenhancement.com. We love getting questions, and we have a few that we thought were a mix of things that came up with questions, and then we had some client or prospective client conversations, and there's always a few little nuggets that we think, oh, you know what, I bet other people would benefit from that. So I thought we'd start with a couple of those. Russ, you okay if I jump right in on this?
Yeah, let's do it.
I was thinking to get us started, when someone puts too much money into a Roth IRA, for example, when it comes to participating in an IRA, we know that there are limitations. You have to have a certain amount of income that is below a certain threshold to be able to contribute to the Roth IRA. And sometimes people contribute more than when they're not allowed to. Either they put too much in, and then that could be another type of thing. You're on an auto pay and you forgot to, you put too much in or something, you had the wrong number, or more likely your income went up and now you're not eligible anymore. So, what do you do? So this has come up a couple of times, as it turns out, just in the last couple of weeks, as we were dealing with tax time. A couple of people noticed that they had exceeded their thresholds. Their income had exceeded the threshold. So, Russ, maybe we'll start with, if you don't have it up, I'll dig it up. The thresholds are for 2026. Do you happen to have that at your
I do, yes. I have my handy
a little cheat sheet, as I like to call it.
Cheat sheet, yeah. Personal financial fact sheet here.
Yeah.
And for 2026, if you're married filing jointly, the lower end of that, the lower end of the threshold, and there's like a range where you could contribute something to the Roth IRA, but not the full amount. But that number is $242,000 in taxable income. So that's for married filing jointly. For single or head of household filers, it's $153,000. So if you make under those numbers, you can contribute the full amount. If you're over, there is a very small window. Let's say for married filing jointly, it's about 10,000 more, where you can contribute something, but not the full amount to the Roth.
So it's important to recognize that, there are different rules for traditional IRAs as to how much can go into a traditional versus a Roth. And in those, sometimes it makes a difference whether you are eligible to participate in a qualified plan at work or not, and so on. But the bottom line here is, if you exceed the income threshold in this instance that Russ just referenced, you might have to back out some money. And whether it's, you mentioned that there's a graduated cutoff, and as you exceed those numbers, you still have a window where you could do some. But if you put in the full amount and then you made more than you were allowed to, you might have to back some out. Or if you became ineligible because you made too much, you got to back out not only the amount you put in, but you have to do a calculation for the attributable amount of your earnings. So there's a formula for that. So basically, you have to look at what you make in the account that year and attribute the proportionate amount to the contribution that gets backed out. So we had some people who dealt with this for 2025 when they were doing their tax year and numbers and realized this issue. And yet, the 2026, the likelihood is they're going to have the same issue. They've been contributing monthly, but stopped, maybe in April as an example. But, we were trying to decide whether to back those contributions out now or wait till the end of the year. And the recommendation was to maybe wait until year end so that we know for sure that their income exceeds the threshold again, because things can change. So that's one reason. And then, of course, we won't know until the year is completed how much, whether the market went up or down, whether their account made money, lost money, how much is attributable to, do we have to account for some profit or do we not? So for that reason, with the two instances where this came up very recently, we thought, okay, let's put that off for a little bit. So that was an interesting one from a client experience.
One other thought on that, or a couple actually. So there's a form you have to fill out. I don't remember off the top of my head what the name of that form is, but you do need to fill out a form to recharacterize and to basically back that contribution out. And that's an IRS form. And then the other two things were, sometimes you might have like a set income. You're
that's
paid
form 8606, Russ, just so you know.
Okay.
I looked it up. But sometimes the broker dealer will have a form as well that will serve as the equivalent to the 8606.
Okay. And then the other piece was, you have your typical income, your salary, and then, you never know. You might have a great year. You might have a big bonus at the end of the year, and you don't think of that as part of your income until you hit tax season, and you're like, oh, wow, this is more than I realized when you add the bonus in there.
I think that's exactly what happened, that there was some bonus income that pushed them over their number. But, you get an incremental salary increase and then a bonus, and that can happen. Right.
And then the other thought, somewhat unrelated, is I've just seen this with clients and with friends as well, where they have the automatic contributions, whether it be to a Roth IRA or a traditional IRA, and they're thinking, oh, that money's going into the Roth for 2025 in 2026, because you have until the tax day, so in April 15th, you have until then to do contributions for the previous year. But if you have auto contributions set up, typically, from what I've seen, it'll automatically default to the next year on January 1st. So you might start a new year of contributions when you intended to contribute for the previous year, if that makes sense. So just something to keep an eye on for those automatic contributions. So you want to maximize what you can do each year up until April 15th, and then switch to the new year if you have to do it that way.
Yeah, I think that if you're doing it monthly through an automated thing, you should expect that's on the calendar year that you're contributing. And if you want to contribute more for last year, maybe that should be an additional check or something, like just something separate. Yeah. Well, that's kind of one of those ones you don't run into all the time, but what's worth remembering though is so it's confusing, Russ, because we have been told so often you can't recharacterize anymore. And you used to be able to recharacterize Roth conversions, but that's been terminated. If you do a Roth conversion, you can't at the end of the year say, "Oh, that's more income than I wanted. I want to back it out." You
Mhm.
can't recharacterize that way. Or the market went down. I'll instead of having converted at a higher level, I'll recharacterize and convert at a lower number. That's not allowed anymore. People were playing games with it. So conversions, Roth conversion, are not allowed for recharacterization. But a contribution still is. If you exceed, as we just described instances, you got to figure out a way to back it out. And there's a limited amount of time before you start accumulating some kind of consequence for having contributed to the Roth when you're not supposed to. So, you do want to address that promptly. I think it's something like 18 months or something.
Mhm.
But in any case, don't wait that long. You know what I mean? Deal with it really by around the end of the year in which you had that excess contribution, maybe the start of the next year. Let's go on to other stuff. What else we got in our mailbag? I was playing around with Russ earlier with the old Rush Limbaugh, crinkling of the paper to go dig in and grab the stuff. We're not actually digging into a mailbag. We've got it all written out here. But,
yeah, we have a more modern mailbag.
Yeah.
So let's jump to this one that was on my mind. So I'm just going to read the question out right now. So
yeah.
From the client, I own a rental property and want to sell it, but I don't necessarily want to pay capital gains taxes right away. A friend mentioned doing a 1031 exchange. What are the timing rules, property requirements, and mistakes that people should look out for? So 1031 exchange is a great option when you have an investment property, you're selling the investment property and buying another investment property.
Let's explain what we're doing. What is it that it is? It just in terms of the tax consequence, you're just deferring the tax. It's a like kind exchange,
Mm-hmm.
and therefore the capital gains gets pushed from the first property onto the next property in this scenario. All right.
Right.
So anyway, it's a way to defer capital gains.
Yeah.
So
that you,
go ahead.
So that you don't have to realize if you made $500,000 on a house and you wanted to buy a different investment property, if you didn't do this 1031 exchange, you'd have to pay taxes on that $500,000 in gain and then go and buy a new house. It's not a very tax efficient process there. So they have this 1031 exchange option where you're just essentially moving it into a new property without having to pay the capital gains at that point. If you eventually sell that house, then of course you'll have capital gains there, unless you do another 1031 exchange, which you are able to do. So it's
all right. Continue on. I'll throw some thoughts at this in a little bit.
So I think generally speaking, when you're talking about investment properties, it's a great option, although it is quite complicated. So it does require some maneuvering. It's not as simple as, oh, I'm just going to call this a 1031 exchange and that's what I'm going to tell the IRS. There's a whole process where you have to involve a financial intermediary, and there are firms that specialize in handling these 1031 exchanges.
Essentially a bank-like institution where when you sell them the property, they take possession of the money. You don't take possession of the proceeds. And then you ultimately apply those to the purchase of the next property. But there's a whole bunch of timelines to be considering in this, right, Russ?
Exactly, yes. And that's what makes things a bit complicated. First, there's this 45-day period where you have the ability to basically scope out the market, see what's out there, and choose 3 potential properties to use as an exchange, right? So
you first identify some properties you intend to use for this purchase.
Exactly. And then you can basically have those 3 listed. And then after that 45-day point, there's another 180 days that you have to close on that property. So in the meantime, let's say
Actually, from the sale of their property.
from the sale.
Okay.
Yep. So let's say,
And I've heard one of the people we work with at Wealth Enhancement mentioned he had his own 1031 exchange effort that failed because it didn't meet that test. They weren't able to close on the property within the 180 days. So it was not successful as a 1031 exchange.
Yeah. So those timelines are very strict and crucial to stay in tune with. Also a good reason to start the process. If that's something you're looking to do, start the process early. Talk to your advisor, talk to us if we're your advisors. It's definitely something we could help
get your ducks in a row.
Exactly. But essentially when you sell that for your existing property, the funds go into an account that's held by this financial intermediary, and very strictly you can't touch the proceeds at all. It has to go directly from the 1031 exchange financial intermediary to the new property that you're buying. So those are some restrictions. And then Chris, I don't know if you want to talk about some of the other.
Well, we came across, as we were talking about it for a particular instance, this inquiry you're talking about, we realized that the individual is intending to use the property quite frequently, and there are also restrictions on how much personal use you're entitled to for this kind of investment property and avoidance of the capital gains. So as you look to this new property, it was either 14 days or not more than 10% of the amount
that it's rented.
Days that it's rented. So there's a limitation to how, you can't live there half the time and consider this to be a 1031 exchange. You have a very, pretty significant restriction on how much use you're permitted. And that's another way it can fail this effort to defer the tax. Remember, all we're trying to do is move from one property to another property, but postpone the capital gains tax. Now, that's another question. And Russ, you give this some thought. Should I postpone dealing with my capital gains exposure? Now, every circumstance is different, but why would I even question that? Why wouldn't you want to just put it off?
Well, the argument for just dealing with the capital gains right now is probably that tax rates are likely as low as they're going to be for a while, especially with capital gains. We have this lower tax environment, and it could be a good opportunity to take advantage of it. And also, as you get older, if you have IRA assets, your income is likely going to be going higher. Your IRA is going to be appreciating. You're going to have higher RMDs as you age. So your income right now might be lower than it is in the future, depending on where you're at in life.
So this becomes relevant to evaluate context, right? Where do you fit in your income relative to where it may be? And what's the likelihood taxes, whether for you or generally, will they be higher or lower in the future? And so it becomes relevant to give thought to as to how to navigate that. And of course, we've been talking with people quite frequently about ways in which they can create tax alpha, generating capital losses that they can harvest while still keeping pace with their investment objectives, but trying to manipulate, if you will, the benefits of capital loss tax harvesting. So something to consider in any case. Yeah.
One other thing with that too is that something that people don't often think about, but we've been talking about a lot, is that these capital losses, short-term or long-term capital losses that you can accumulate, don't expire. So if you have losses from investment a long time ago. You might still have them on your tax return, and they're still being chipped away at in terms of, being offset by capital gains. So those losses are actually pretty beneficial, especially if you have properties you're looking to sell.
Yeah, and if you have runway where you're not selling this, in this case, we were talking about a real estate property, you're not selling it yet. Maybe you have time to accumulate some losses with other taxable investment money to try to help reduce some of that burden, that capital gains burden. In any case, a lot of things to think about. 1031 exchange is got a lot of sizzle. It's really interesting and sounds very appealing. It is very complicated, and it's not always. Sometimes it's not always, convoluted is not always the best way to go. So it's worth thinking it through before deciding. But it's nice to know that it's an option. Particularly see this most with real estate, wouldn't you say, as opposed to other types of assets,
Yeah,
for this,
definitely.
kind of exchange. So,
Definitely.
all right. Well, that was a good one. What else we got, Russ? We got more questions from the mailbag here.
Yeah. All right. Here's another one. So this is a big one. I've worked my whole life, but I'm approaching retirement with very little saved outside of Social Security. What should someone in our position focus on first?
Oof, that's a tough one. Now, everyone's circumstances are different. We do find sometimes we have run into all different kinds of types, right? Some people are planners to the infinite degree. They're like, every last little thing is considered and detailed. And sometimes those people, Jeff Perry used to talk about, they needed permission to use their money, right? So, you're good. You can do it. And then there's other people that are kind of like by the seat of their pants, right? And just, well, I'm done,
Yep.
And I will say that as you think about this, as our listeners think about this, you have to be preparing for life events that can change suddenly, whether it's your health, the health of your company. Will you suddenly be retired, unexpectedly, because of layoffs? Other kinds of life events, maybe even just burnout. So if you haven't been preparing for these things, your options are more narrow, right? By doing some of that preparation in advance, you're more ready for whatever comes your way. Now, in this case, someone who's kind of late in the game, what do you do? Well, I think some of this depends on a couple of things, and you'll be probably even better to address some of this than I. But for example, how much you spend becomes really relevant to the question of how ready are you? How prepared are you? How much you've saved, in this case, sounds like not very much. So that becomes a notable consideration. Whether you have pension income, military, public service, a large company, we don't see pensions as frequently as we used to, but now people mostly have 401k assets. So is there, retirement money at work, but just not in a investment account that they, didn't mention here? But assuming there's not, I think the first thing you need to do is get a financial plan together to see, and part of that is really understand, where are we spending money? What will the future look like? Will we have more or less cost in our retirement? Are we staying in the same home? Are we moving to somewhere lower cost and maybe eliminating a mortgage in the process? Are we renting versus buying? What are our circumstances that will factor into these numbers? What are the unexpected expenses, which, Russ, you help clients navigate routinely when we're doing financial plans, whether it's buying cars from time to time or, by maybe improvements on the home or
Mhm.
taking some travel money or whatever it might be. But what is that going to look like? Because we don't know what they're spending, and how much will their Social Security be relative to that number? Um, we do see people working longer, maybe part time, even not to help soften the blow when it comes to what their retirement will be.
Yeah.
But I would argue you need some reserves, you need some investment, you need some savings, and without that, I would really question whether you're really ready for retirement, um, even if it means working later than you'd like. How
Yeah.
how would you answer this question?
Yeah, well, a few things come to mind. First, I think if you find yourself in this situation where you're thinking about retirement and you realize it's a little too late that you started thinking about it,
Hmm.
you have to be flexible. That's probably the number one thing because
I mean, it's
usually,
never too late to be thinking about it. Just earlier is better.
yeah, later than you'd like, I guess.
Yeah, yeah.
Yes, definitely never too late. It's always better wherever you are
Got
to
to
start
start
doing
somewhere.
something.
Yeah.
Um, but you know what? I guess I think like people are so caught up in their lives and their day to day, and they're used to having jobs their whole lives. They reach their 60s, they've been working for 30 plus years, and the thought of just this is the income we have, this is the money we have to work with, not really giving a lot of thought to there was going to come a time where I don't want to keep working or I can't keep working, and then that income is going to stop. So it has to be supplemented somehow. If you don't have the savings, then it really leaves you in a bit of a pinch. Um, but just kind of getting out of that day-to-day mindset, stepping back and looking at like, you know, this is something I should really look at, something I should really plan for. And if you're not a particularly good planner, that's not a knock on anyone. There,
Yeah, just because
that's
different priorities, different skill sets. Sure. Yeah.
yeah, exactly. But one thing I was thinking about is like you kind of mentioned it with having the flexibility to say, all right, if I don't have what I need to retire and have sustained my lifestyle, and I'm not going to sacrifice my lifestyle for any of that, maybe looking at somewhere else to live. And let's say you have a house that's really appreciated. It's been in a great location, for example, Cape Cod. House prices have really gone up, and looking at places to move to. And it's maybe not the ideal solution, but you can really downsize and have a lower cost of living somewhere else. That's not going to be a magic salve to your issues with cash flow, but it'll definitely help. So that's one thing we look at. The other thing is we say it's money in, money out, right? So it's either you decide to spend less, and when you break down a budget, there are always areas where you can find, as painful as it is, there are always areas you can find that you can cut. It's not fun to do, but it's something sometimes necessary. The other is money in, and as Chris mentioned, part-time work is always a viable option. It could be something a couple times a week, something that you might like or be less stressful than your current job. But having some regular cash flow and ability to save a little bit more does make a big difference. When we look at the difference between $1,000 a month in retirement, in terms of spending, that can really move the needle to a plan that works a lot better if we're saying we're going to spend $1,000 less, for example. So lots of variables, but like Chris said, it's never too late to start considering how can we approach this, and we should start planning, because the longer you push it off, the worse position you're going to be in.
I would also point out that sometimes in circumstances like that, where there just isn't a lot of investment savings, I do see a lot of times those people have prioritized debt reduction, and they might have their mortgage paid off. And so, it may be that either a reverse mortgage, if not the downsizing, that there might be some avenue to extracting some of that equity in the home. as a resource. I do think sometimes we see people who have a lot of equity in the home and a home of a substantial size that when it comes to if they would consider downsizing and scaling back maybe to a condominium or an apartment or something, or relocation where real estate might not be quite as costly, the math can work a lot better than putting it off. Well, and to wrap that up, let me just say, if we can be of any help to you as you deal with these kinds of considerations in your planning, we are happy to be a resource. We offer a complimentary consultation, and it's really a 2 meeting process. Take advantage of it if you think you'd benefit from a second set of eyes. Maybe you are doing it on your own and maybe not sure what you don't know. You know what you know, but you're not sure what you don't know. And or you're in a position where you think maybe the person I'm working with isn't quite giving you everything you expect, and see if there are alternatives that would fit your needs better. So if we can be part of that process, happy to speak with you. Don't hesitate to reach out. You can connect with us at amr-info@wealthenhancement.com or give us a call at 508-771-8900. Thanks for being with us for this episode. And until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.